and welcome. It's my pleasure to welcome you all back to our next Lunch and Learn with a wine. Here's my little wine. Not sure if anyone else has got one. Technically, it's past 12 o'clock, so we can have a bit of a sip. It's our next in our series of our Lunch and Learn workshops. It's our MDA quarterly update, and we're here thanks to Virtual Financial Advice. My name is Paul Jantz. I'll be your host for today. Before I introduce you to our couple of guests, just a quick little session on what these are about. And I think we started these probably last year, Adam, where we decided to just introduce a new layer of different sort of workshops to all of our clients, to where, it was probably more, call it an educational side. So bringing different guests to share different ideas, different thoughts of what is actually happening in the marketplace. It's on the back of our podcast series that we did last year as well, which was our Talking Numbers Investment Plus series, where I spoke to Adam in depth about a number of key things. And I know we did a Investment Plus 1 and Investment Plus 2, I think, from memory. And then we also did one with Talking Numbers Property Plus, where I spoke to a property expert about investing in property. Again, all general advice provided. Let's get into today, because I've got my little wine glass here, and I'm going to say hello to our couple of guests. Firstly, Virtual Financial's Adem Becirevic. How are you, mate?
Yeah, good, mate. Very good. As you said, obviously everything today is just general advice only. So, please, if you want advice going forward, please contact and make an appointment with the office moving forward. But look, going great. I think these quarterly updates of the MDA are essential for our clients. Our clients love the MDA. They love the idea of, having risk-adjusted returns, having investments that don't act the same way when the share market goes down, and that aren't correlated, that they act differently. And we have some really kind of quirky and different sort of investment strategies, which obviously Rob, who's the CEO of Shartru and the investment manager, who will talk about some of the investments they've got that are really, really interesting. And at the end of the day, the most important thing for us is to not lose any clients' money. And if we can also, get that little bit of return there to make sure we're on track for their retirement. So when we're doing the retirement calculations, we're normally working around 5 or 6%. So with that, we're not trying to get 40% returns, we're just trying to get a nice consistent return. And when markets go down, we want to be able to protect the capital.
Well said. And it's probably a great little segue to introduce Rob Coyte, CEO of Shartru Wealth. How are you?
Yeah, good. Thanks, Paul. How are you?
Really good, mate. Good to have you back here. Good to have. It doesn't feel like it was that long ago before we were talking to you about the last quarterly update. So that's how quick time goes.
Time flies.
It is nuts, isn't it, to think that we're in November next week, and wow. And then, of course, it's all chaos, and then we're into 2024. So we're going to touch on a few of the things that, that Adam just actually mentioned there. And we're going to talk about, go into a little bit more depth about all of that. You spoke about the risk-adjusted approach as well, Adam. So we'll get into that over the next 30, 35 minutes. If you've got any questions, to you guys out there that have got any questions throughout the session, please throw them into the Q&A. We will definitely address any questions you may have to Adam or to Rob at the end of this session. So what we're going to look at is, over the next 30, 35 minutes, is a bit of a market update. What's happened the last quarter? Then we're going to have a look at a couple of, let's call it, hot stocks and what's been happening in the market. We know we're in an interesting place now. I know just offline that we were talking about potentially a couple of wars going on at the moment. So how is that going to affect things? We'll talk about the Gerroa MDA Growth Fund as well, how it's tracking. And we'll also talk about the risk-adjusted approach, because again, as Adam mentioned, it's not about losing people's money. It's about making sure that we're actually smart in growing your portfolios for retirement. So let's get into it. It's been an interesting few months again, cost of living continuing to increase. I saw today, actually, maybe about an hour ago, I saw that while inflation is slightly higher up for the quarter, it's also on the decrease, which is great, which was out today. So, but there is also, because of that, interest rates are tipped again for Melbourne Cup Day to go up. What's your thoughts on that, guys?
Rob?
Yeah, well, let me start by saying I don't actually believe the CPI numbers. I actually think inflation's a lot higher than what they tell us it is. And I think anyone on this call who pays bills, which is all of us,
yes,
would agree. So always wary of the CPI number. But what it does do is it tells us what central banks are thinking. And at the end of the day, it's not as low as what they would like. and hence they will probably keep fighting this fight against inflation for as long as they can until basically something stops them from doing that. What that is, we don't know, but inevitably that's what will happen.
Yeah, so I think it was 5.4%, although down from 7.8, which is good. And you don't believe that it's at 5.4.
I definitely believe the trend is down.
Down, yeah.
But in saying that, I personally think we're at the end of cheap money, we're at the end of cheap energy, and we're at the end of cheap labour. So if you're trying to get a 2% inflation rate in those sorts of circumstances, you're pretty clever if you can pull it off.
Yeah, very true, very true. Well, that's great to hear anyway. But let's kick off with a bit of a market update. What's been happening in the last quarter, Rob?
Sure. So what I might do is I might just share my screen. So basically, we've got the quarter was fairly negative for markets. One of the interesting things that continues to happen is interest rates. So what we're looking at here is the long end of the interest curve for the US Treasuries. So this is the 10-year borrowing rate. So as you can see, that interest rate from, let's just say, mid-2023 has gone up to around about 5% from 3.5%. What that means is that anyone who borrows money, which is pretty much anyone, is feeling that pain, and that's going to have an impact on asset markets. We've already spoken about inflation and what the central bankers are doing, and what that does is it provides uncertainty for markets. And basically, I think what we saw this quarter was a bit more of a retreat from the risk on play, and people were sort of getting a bit more cautious, and hence markets sold off. And as you can see for the quarter, most of the assets were down a good few percent, with property and global infrastructure having quite large declines of 3.5% and nearly 5% respectively. So that is interesting. In saying that, in the next column we've got the 1-year movements, which is obviously looking a hell of a lot healthier. But from last quarter's perspective, I think there was definitely a reality check from markets. And to be honest, I think we're probably going to get more of the same this quarter, just given that everything that's going on, particularly with the Middle East taking off. The other thing I'd note, talking about risk-adjusted returns, is we're talking about what is actually moving the US equity market at the moment. And they've got this concept of what they call the Magnificent Seven. And this is 7 stocks in the US that have basically driven pretty much all of the equity, the upside in equity markets since the end of COVID, effectively. So as you can see in this graph, there was a huge run up pre-COVID, a big sell-off, and they're basically rallied back up to where they were. This chart very much reminds me of the internet boom, and this is exactly the sort of thing that happened there. So long story short, one of the strategies we're employing in our international equity portion is we're making sure that our exposure to the so-called Magnificent Seven isn't going to undo us should the price fall back to what we would consider more reasonable levels, which we think there's a very high probability that will happen.
Excellent. I know you've spoken about the Magnificent Seven in the past, and they're mainly tech companies, fair to say? Yeah,
technology, and of course the latest fad hitting the market at the moment is artificial intelligence.
Of course, AI, yes.
Which no one knows how it works, but it's going to be wonderful.
That's exactly right. Scary to think that what is actually happening out there, what we see in the media and what can happen, is interesting, to say the least, with what AI can actually do. You mentioned a little bit of unrest in the Middle East at the moment. Obviously, I saw that our Australian troops are about to deploy over there this morning. So taking that into consideration and the opportunities, what are some of the opportunities that may exist in terms of, let's call it, hot stocks that you are looking at the moment?
Yep, absolutely. We can definitely do that. Now, before I'll do that, I just wanted to have one final comment on this interest rate chart. Money, like everything else, is priced using demand and supply. So if demand's greater than what supply is, the price will go up. If supply is greater than demand, the price will go down. The US is currently running quite large deficits, which means it's spending more than they make. And now they're facing potentially being in two wars. Wars aren't cheap, wars are expensive, and wars are inflationary. So the other thing that this interest rate curve is telling us is that, and I think we touched on this last quarter, that a lot of the BRICS and a lot of the emerging nations around the world don't necessarily want to be saving all of their reserves in the US dollar assets as they have done in the past, and they're diversifying into other types of assets like gold, et cetera, et cetera. So what we're seeing is we're seeing a decrease in demand for US debt at the same time that we're seeing an increased supply of US debt. That leads to higher interest rates. So I think that's probably one of the very important backdrops that we're sort of managing the portfolio on that basis at the moment. And we're still making sure that we're being defensive for that to happen. In saying that, there is always opportunities. And some of the things that we're seeing at the moment are very interesting. And probably, you know, I thought what I might do is just start with the stock standard one. Sure. This is probably not exciting to the nth degree, but to me, it's the basics of investing are what makes, you know, a successful investor. And I think this is a good place for us to start. So Vicinity Shopping Centres. So they own a portfolio of shopping centres with 98.8% occupancy. Now, if we have a look, they've got 59 centres across Australia, worth about $14 billion. Okay, and the sorts of things that they sell at these shopping centres, food, retailing is obviously the main anchor tenants, your Coles, your Woolies, these sorts of things. People are going to eat, regardless of what happens in the world. And, you know, and then we've got more, I guess, discretionary spending after that. Now, generally, when we're looking at these sorts of things, what we want to make sure is what are the financials looking like? Now, basically, from a cash flow perspective, once these guys pay their obligations, they're going to be yielding probably up around 7%. In income back to the investors. So that's not to be sneezed at when we compare it with other sorts of investments that are out there in the market. Importantly, is the main thing that you need to be wary of, well, not the main thing, but one of the things you have to be very wary of with property is the level of debt. That's where most of the time property comes undone. People have too much debt. Debt levels are at about 25%, okay, and an average cost of about 4.6%. So it's not a hell of a lot of debt in the grand scheme of things. And importantly, the other thing we analyze when we're looking at the debt is we look at when is the debt mature and when is it going to have to roll over? Because no different to you as an individual, when the debt matures, they've got to be able to go and refinance that. And obviously, that was the issue we saw during the GFC, when people had huge amounts of debt to refinance and no one wanted to refinance them, and then the music stopped. So the one thing that we're always looking at when we look at these sorts of investments is making sure the debt maturity profile isn't all on the left-hand side, i.e. coming up, and it's spaced out, which as you can see, it is. So it's a very boring type investment. The investment is actually, it's been sold down from its highs quite substantially, around 30-odd%. So we actually think we're getting some decent buys at this level for what is in essence a pretty boring business. I guess one that is a bit more exciting, and definitely plays into a number of the themes that are happening at the moment, is definitely our exposure to gold, and also the gold miners. So basically what happens is, if you look at these charts that we've got here of gold measured against currencies, and I'll note that US dollar isn't in this chart, isn't in these charts, but you can see the price of gold in pretty much all currencies has gone up. And that's basically saying that people are looking for real money, and they want to get away from the fiat. The US situation is not as predominant as these ones, but it's definitely looking a lot interesting at the moment. Now, gold actually sold off a few weeks ago, and whilst our view on gold is very positive, we're also very positive on gold miners. Gold miners, obviously, if they're digging up a product that is increasing in price, their profitability will be going up. So gold miners is actually a leveraged play on the price of gold. And we took advantage of the opportunity to buy some gold when it was down, and that position's already rallied 15% in a couple of weeks. Now, interestingly, if we look at the long-term trends, what we've got on this graph is we've got the price of gold tracked to the price of the gold miners, the companies, and you can see it pretty much tracks, and then we start breaking away, and we've got gold companies down here relative to the price of gold. So what that's telling us is historically, the price of the gold mining companies is considerably cheaper than what would be expected given the current price of gold. So that way we sort of see that as an even more compelling reason to actually do something that we think makes sense anyway. Mm. So there are a couple of the opportunities that we've taken advantage of in the last quarter, because regardless of what goes on, there's always something that is looking attractive and something that we want to be involved in.
Exactly right. Well said too. Adam, any thoughts from yourself there, mate?
Yeah, well, look, I think in relation to the property one, I had a look at where those properties are. They're in like major cities, across the road here, Queen Street Mall, and down in Melbourne, they've got that beautiful Victoria building, whatever it's called. It's great properties like top shelf. So obviously potentially boring, but obviously has a great story. I think the difference between us and maybe potentially, and I think Rob might talk about it, like a Q Super or industry funds, where they have to go and buy $100 million or whatever it might be, and Rob might touch on Q Super, where they bought a property over in New York and went pear-shaped, right? But being a smaller group and being a boutique, we get the opportunity to invest in other investments like this one he showed today. Whereas it's not that easy for a big industry fund to go and buy $100 million. We don't need to do that, so that we've got access to a lot more opportunities in the market. Yeah,
absolutely, Adam, and most importantly, we're more selective, right? Yeah. So we can choose which risk we want to take and which ones we want to avoid. Now, for example, the property that you mentioned from Q Super, that was a New York-based property. And New York's not a place. New York, San Francisco, Los Angeles, they're not places you want to be owning commercial property at the moment. In saying that, it wasn't a top quality building. It was what they call it was rated a B type building. But the other thing was the debt was very large. So I mentioned in the property that we just had a look at, the debt was 25%. The one in New York was actually about 80%.
Yeah.
Right. So if the price goes down 20%, you're in negative equity.
Yep. Right.
And that's in essence what happened. In most of our portfolios that we hold property, we're looking at the A grade properties, and we're looking at very low levels of leverage because, as I said, it's debt that effectively blows it up. And that's coming back to the risk adjusted basis. That's exactly what we're doing. We're doing the lower risk end and we're ignoring the higher risk end. So hopefully we're going to avoid that scenario.
Fantastic.
Well said. Would you guys like to talk about the performance of the Gerroa MDA Growth Fund?
Yep, sure. So basically, as I sort of said, the markets were pretty heavily down on risk adjusted basis on risk assets. I think in the main, the Gerroa growth was probably down about 0.5% for the quarter, which is not a bad result relative to some of those red numbers we saw a bit earlier. Our benchmark peer was around about 1% down for the quarter. So whilst we don't like being down, we do like being down less than our peers. In saying that, I think Adam touched on the point that, property got hit hard, and also infrastructure got hit hard. Now, they're asset classes that we really like because over the long term, they provide us income. And income provides a buffer for capital price because if you're getting income, people are willing to pay for an asset. If you've got blue sky, everyone's got to be in a really good mood to scratch out a check. So notwithstanding the fact that those asset classes were quite negative for the quarter, and a lot of that was to do with definitely the inflationary pressures, but also the higher levels of interest rates coming through. Because what that means is people sort of say, well, why do I have to own these sorts of assets over here that are potentially more risky when I can just go over and I can buy a term deposit and get my 5%, and that's all the things that will happen. The reason we don't do that on a long-term basis is because of inflation. Okay, so our term deposit will always be 5%. And that's what it'll always get. And as I mentioned earlier, if inflation's running hotter than that, well, we're not going to be able to keep up. Whereas our property and our infrastructure assets, the income stream that we generate from them is basically linked to inflation. So when we look at the properties, for example, the leases are all structured. So every 12 months, the price goes up by inflation. So it's a natural hedge. When we're looking at infrastructure type assets, so whether it's toll roads, whether it's airports, whether it's our utilities, our electricity, our gas, whatever, they always just go up with inflation. Even regulated assets, they go up with inflation. So that's why we like those sorts of assets from a longer term perspective. And sometimes we've just got to take a bit of short term pain to be able to access those assets relative to the cash alternative, which won't keep up.
Well said, Adam. Anything else you'd like to add to that?
Yeah, look, I just think the way that Rob and his team and Clint and the investment committee kind of help our clients is really valuable. And we've got people, professional people looking after our portfolio for our clients. And I tell all our clients, we can make changes, and these guys can make changes when they need to. And I think that's really, really important. So they don't have to worry about, obviously if the war gets worse, obviously there'll be strategies that Rob and Clint and his investment committee will put in place to, maybe make it more to cash, more to fixed interest, whatever it might be. They don't have to think about it. But they know they've got a good team behind them, which is fantastic.
Well said. Well said. So, are there any sort of likely changes that you can see or forecast as we head towards 2024?
Yeah, well, from that perspective, I think as markets weaken, that means that that will present opportunity because the price we're paying for assets goes down, hence the opportunities arise. So whether that's and I think pretty much the consensus is if we're not in a recession already, we're going into one, and yada yada yada. But if there is further weakness, those opportunities will present themselves, and that's exactly what that's when we get excited, and that's when we're looking to deploy capital to where those opportunities are. So at this stage of the cycle, what we're trying to do is really avoid the Magnificent Seven type scenarios. We don't want to be exposed to large drawdowns that will not come back. Yep. And protecting our capital and then making sure that we can deploy it to the next opportunities that present themselves, which are opportunities based on fundamentals and a lower level of risk, as opposed to, we're just fortunate enough to be in on the next trend and, because what that's going to be, I mean, who knows, right? And that's not the game that we play, not with clients' money. It's too important, and people are more interested in making sure they've got enough money to feed the dog and do what they need to do to make sure that life continues on, as opposed to sort of being exposed to the next best fangdangle thing.
Well said, well said. And I think you mentioned it as well, and Adam sort of touched on it as well earlier, in terms of no one likes losing money. It's about preserving that capital, and that's why the risk-adjusted portfolio MDA works so well, isn't it?
Yeah. And look, in saying that, there's going to be negatives, right? But it's about making sure that we're minimising them, and we're only owning assets that are going to come back. That's the trick.
Well said. Anything else you want to add to that, Adam?
Yeah, look, I think we're investing for the long term. And what I say to the clients when I see them is that, we're not chasing 20-30% returns. We don't want to lose money, because you got to virtually earn double. If you lose money, you got to earn double to get it back again. So if you don't lose it in the first place, it makes it a lot easier to achieve your retirement goals. And at the end of the day, clients just want a comfortable retirement. We do a retirement plan for all our clients every time we see them. And we know they're on track, and we've got it all based around a 5 or 6% return. We're not doing 16, 18% return. So, and we know long term, the portfolio has done that.
Yeah, well said, mate. I don't know, we were talking about the weather just before. I don't know if you heard it. It was probably so loud here. All hell just broke loose out there. So quite incredible that Melbourne's just changed like that. Who would have thought?
Who would have thought?
Seriously, I've just gone, what is going on out there? Look, before we get to look to wrapping up, if anyone's got any questions, please drop them into the Q&A bar. I think I'll go to one now. I think I saw one there from Rod. The question is, so you're saying even if the capital of the assets go up and down a little, the income or the payments we receive remain stable?
Absolutely. That's the whole idea. And that was a lesson that was learnt by many during the GFC. So what happened in the GFC was a lot of people had investments that went down, but then also the income stopped.
Mm.
And when your income stops for 18 months or 2 years, and the assets are all down in price, that's not a good scenario, because then what we're forced to do, because the dog's still hungry and it wants to be fed, is we have to sell the assets that are down in price, and then to free up the cash to be able to pay it out. So the thing that we're always cognizant of is we need to protect that income coming through. And the last thing we want to be doing is selling assets at a time where they've decreased in value.
Well said. Well said. And great question as well, Rod. If you've got any other questions, please throw them into the Q&A. I suppose, guys, have we missed anything? We've just gone on 35 minutes, which has been spot on the money. Have we missed anything? Any parting comments, Adam?
Oh, look, I think, it's great holding these every quarter. As I said, there's before the meeting, there was probably 20 or 30 other clients that wanted to attend. They told me that they want to watch the replay. So we'll definitely get that out in 2 or 3 weeks' time for our clients to look at that. And we'll keep holding these quarterly, keeping our clients up to date with what's going on. And it's been very well received by everybody. So thanks to the clients for supporting us, and we're going to support you moving forward.
Well said. Rob, any parting comments, mate?
No, Paul, I think I've said enough.
Well, not only have you said enough, you've also shown us, which I actually like the graphs. I'm a bit of a visual boy myself, so yeah. I actually like looking at that and seeing, and then having that explained to me as well, because sometimes it could be goo gaga, but the way you've explained it as well has been fantastic. So I certainly appreciate that, and I always look to learn something myself every day. So I've learned something today, which is good.
Good job.
I like the gold aspect.
Yes, exactly.
Everyone that's joined us, yeah, look, I agree with Adam. There was a number of clients that couldn't have joined us today, and they've asked for the replay. Hopefully it's like 2 to 3 weeks. Hopefully we get this into post-production, and we should have it out by next week. So we'll send the link out. If you guys want to obviously watch it again, it'll be shared on our socials, and then you'll have access to it through our YouTube channel as well. So Adam, thank you for joining us. Rob, thank you for joining us. It's always fantastic to have you on here for our quarterly update, mate. So we really appreciate your openness and your honesty and your thoughts and your comments as well. So
yeah, thanks, Rob. Really appreciate it.
Thanks for having me.
And Paul, thanks for hosting, mate. Great job.
It's my pleasure. To all of you that have joined us, thank you very much. Enjoy the rest of your day. Hopefully it's sunny out there and not, oh, look, the sun's coming out. Funny about that, eh? Not in Melbourne, but I know you're all around Australia. So thanks and enjoy the rest of your day.